Thanks for joining us this week for our weekly iteration of the Signature FD investment audiocast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start with our chart of the week, and we called this one Schools in Session because sadly, my kids have actually gone back to school as of August 1st. And as I was putting them on the bus, I noticed how dejected they looked and seemed that school was starting again. And I recognize that it's probably going to be that way for the first month or maybe even two of the school year until they get adjusted. And that reminded me of the seasonal pattern in the stock market where you actually do tend to get an August and September blues period where corrections become more likely. And so what we're showing here is we're actually showing a presidential cycle. So the blue line is the average trend of the S&P 500 in the first year of the presidential cycle. And you can see that that line tends to peak out in very early August and get some corrective activity through September until we get into October. Thus far, the dashed orange line is what has happened year to date, and that shows that the market has actually tracked this historical tendency pretty tightly so far. So it would not be abnormal to get some sort of correction here in the August September timeframe. And that did start a little bit last week. When we look at market action here, you can see that most major stock market indices did have some corrective action on the week. Still, returns are solid year to date. So the S&P 500 through last Friday up about 6.9%. And international stocks are both or in the range of 16 to 18% on the returns. So still been a good year for investors, but a little bit of corrective action was starting at the end of last week. That said, market breadth is solid, not spectacular, and typically when market breadth is okay, and we define that as greater than about 35 40% of stocks in a longer term uptrend. That's what we're showing in this chart in orange here. When breadth starts from a place that is more solid rather than very weak, we can go ahead and have a little more confidence that the cyclical bull market is intact. And that's what we think we have today is we have correction risk in the upcoming few months, but we still think that the benefit of the doubt should go to the bull market. Now, when we look at macro data last week, I think the big headline was the jobs report on Friday. What we did see was a pretty weak number in job creation for July, 73,000 new jobs. That itself would have been the weakest month in a while. But there was big downside revisions of 258,000 jobs to the prior 2 months. So you can see in the blue bars in the top clip just how weak job creation has been over the last 3 months in comparison to a longer time period. So we are noticing some cracks here in the labor market. We don't have jobs outright contracting yet, but growth has been weak. Now, some of that can be explained by a shrinking labor force, immigration policy. You've had people leaving the labor force, probably not as many jobs to be created when you have people leaving the labor force, but it doesn't explain all of it. So this chart here just simply shows the unemployment rate in blue, and the unemployment rate adjusts for changes to the workforce, and the unemployment rate has ticked up to its highest level in some time, about 4.25%. Now, when we think about Fed policy, the Fed believes that their estimate of full employment is 4.2%. So a reading around 4.3% or more should catch the Fed's attention and bring us a rate cut here in September. That said, the monetary policy is complicated here by inflation that has still been pretty sticky. So here we're showing in blue, this is the personal consumption expenditures price index. That's the Fed's favored metric. And then in orange is the core, which strips out volatile food and energy components. And you can see that in the last update, these did actually tick higher. Headline inflation running 2.6% and core inflation running 2.8% is still quite a bit higher than the Fed's target of 2%. So it's a really complicated picture for monetary policy right now. And we'll see where we go from there. If the employment situation continues to soften, we do project that the Fed will cut in September. Now, not really corroborating the weakness that we saw in the jobs report, the earnings growth for the second quarter has been pretty solid. If we look at earnings growth on the right and sales growth on the left, we can see that in gray at the S&P 500 index level, companies have grown earnings so far of those that have reported have grown earnings almost 8% on sales growth a little bit north of 5%. So that's pretty solid earnings growth. And the fact that earnings has been growing faster than sales tells us that profit margins have actually been expanding. And that's been a trend that we've seen over a number of quarters here. So the fundamentals for the equity market are hanging in despite some weakness in the economy. And at the end of the day, that's really what matters to investors. Now, another thing that we can take is a potential positive that supported the market rally since April and could continue to be a support ongoing is that we are starting to get some resolution or some idea of where the trade policy is going to line up, particularly what the actual tariff rate is going to end up being on a blended basis. And it looks like it's going to be something around 15% on a blended basis. Obviously, not as bad as what we saw from the Liberation Day tariffs, not as high. And what we're showing here in orange is a trade policy uncertainty index. And you can see that very high spike here, especially around the Liberation Day tariff announcements. But that's been coming down as some deals have been struck. And traditionally, the market tends to perform poorly and the economy tends to perform poorly when trade policy uncertainty is rising. But as it's eroding or coming back down, that's been a better environment for the economy and the stock market as well. So trade policy peaking and starting to ease the uncertainty around it, that's potentially a tailwind as well. So some closing thoughts for the week. In our chart of the week, we showed that the next 2 months have been seasonally weak. So a correction here in these next 8 to 10 weeks or so, that should not come as a surprise to investors. And there was a bit of market weakness, particularly at the end of the week last week, but the long-term uptrend does remain intact. And it's important to go with the trend of the markets, especially on an intermediate to long-term basis. Now, the employment report was something of a clunker. And inflation has been stickier than I'm sure consumers or the Fed would like to see. And that's complicating Fed policy. Even so, the Fed is likely to cut in September in the absence of an economic acceleration. Now, the earnings support has been there, especially from a Q2 earnings perspective. The strength is not necessarily confirming the message that we've seen from the employment figures. Solid earnings here are supportive of the market uptrend. Now, a peak in trade policy uncertainty is also adding some support. Tariffs are still high. They're the highest level since about World War II, but some resolutions on some of these trade deals that adds in some more business certainty and can be seen as potentially a tailwind. So that's what we have for you this week. And as always, we want to thank you for tuning in and wish you a great week ahead.